If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Sharing it with your friends and family helps spread knowledge. And when we help others grow, we grow too. Thank you so much for listening. Let's dive into the audiobook. Chapter 1, The Human Side of Wealth. Part 1, Unique Money Stories. When Warren Buffett was 7 years old, he discovered a worn nickel on the ground outside his grandfather's grocery store. Instead of spending it on candy, he bought a pack of gum and sold individual pieces to his classmates for a profit. Meanwhile, across town, another child might have immediately traded that same nickel for a piece of chocolate. These seemingly insignificant moments create the financial DNA that guides our money decisions for decades. Every person carries a unique financial story written by circumstances beyond their control. The child who watched parents argue over bills develops different money reflexes than someone raised in a household where financial discussions happened openly around the dinner table. These early experiences become the invisible operating system running our adult financial lives. Consider the contrasting money stories of two successful entrepreneurs. Reid Hoffman, LinkedIn's founder, grew up in a middle-class family where his parents emphasized education and long-term thinking. His approach to wealth reflects this stability-seeking foundation through diversified investments and measured risks. Compare this to Jan Koum, WhatsApp's co-founder, who immigrated from Ukraine at 16, cleaned floors for survival, and experienced genuine poverty. His financial decisions show an entirely different pattern, focused on security and cash preservation. Shaped by memories of genuine scarcity, culture adds another layer to these personal narratives. Japanese families often teach children about money through the concept of mottainai, avoiding waste and finding value in everything. This cultural programming creates adults who approach spending with fundamentally different assumptions than someone raised in a consumer-driven American suburb where credit cards and instant gratification formed the backdrop of childhood. Your money story doesn't just influence how much you save or spend. It shapes what you consider risky, what feels like enough, and even what constitutes success. Someone whose parents lost their home in 2008 might view real estate as dangerously unstable, while their neighbor who bought property at the bottom sees it as the path to wealth. Both perspectives stem from lived experience, not financial analysis. The most successful investors recognize this subjective reality. Ray Dalio built Bridgewater Associates partly by acknowledging that his Depression-era father's extreme risk aversion had shaped his own investment philosophy. By understanding his inherited money story, Dalio could separate emotional programming from rational decision-making. What story has money written in your life? Perhaps it was watching a parent work multiple jobs, experiencing the security of a steady paycheck, or witnessing a family business thrive or fail. These experiences become the lens through which you view every financial opportunity and threat. Recognition marks the beginning of financial wisdom. Your money story isn't right or wrong, it's simply yours. But understanding its influence allows you to make conscious choices rather than unconscious reactions when facing financial decisions. The goal isn't to eliminate your financial personality, but to recognize when it serves you and when it might lead you astray. Part 2, The Power of Experience. When Jeff Bezos was 12 years old, his family packed up their Chevrolet Blazer for a cross-country road trip. His grandfather, a rancher and atomic energy commissioner, had instilled in young Jeff a profound respect for long-term thinking and calculated risks. This early exposure to methodical decision-making would later influence Bezos's willingness to lose money for years while building Amazon. Meanwhile, across the country, another future billionaire named Howard Schultz was watching his father struggle with a series of blue-collar jobs, never able to build lasting security. These vastly different childhood experiences shaped two entirely different approaches to wealth creation, risk tolerance, and business strategy. Your financial experiences create a personal database that your brain references every time money decisions arise. If you lived through the 2008 financial crisis as a young professional, watching friends lose jobs, you might naturally gravitate toward conservative investments and emergency funds. If you grew up during the booming 1990s tech expansion, market volatility might feel less threatening and growth stocks more appealing. Neither approach is inherently correct. They're simply products of lived experience. Consider the tale of two investors who both witnessed the same market crash of 1987. Sarah, then 25 and watching her parents lose their retirement savings, developed an intense aversion to stock market risk. She spent the next 3 decades primarily in bonds and savings accounts. Robert, also 25, but whose family had minimal market exposure, viewed the crash as a learning opportunity and continued aggressive stock investing. By retirement, despite experiencing identical market conditions, their financial outcomes differed dramatically due to their experiential responses to the same event. Research from Malmendier and Nagel demonstrates this pattern clearly. People who experienced high stock returns during their formative years consistently take more financial risks throughout their lives. Those who live through market crashes or economic depressions maintain more conservative portfolios decades later. The data isn't just theoretical. It shows up in actual investment behaviors, retirement planning, and even career choices. This experiential bias explains why financial advice often falls flat. When a financial advisor recommends a diversified portfolio to someone whose family lost everything in real estate, that advice battles against years of embedded emotional programming. The client isn't being irrational. They're being human. Their brain has cataloged real experiences where property investments cause genuine suffering. What makes this particularly fascinating is how incomplete experiences can be. You might have witnessed a neighbor's small business fail spectacularly, creating a lifelong fear of entrepreneurship. But you never observed the 20 successful small businesses in your community because they operated quietly without drama. Your experience database contains vivid failures but lacks mundane successes, skewing your perception of entrepreneurial risk. The key isn't dismissing these experiential influences, but recognizing their power. Your financial experiences are valid teachers, but they're not complete educators. They've shown you one version of how money works, not the only version. Understanding this allows you to honor your experience while remaining open to evidence that challenges your established patterns. Part 3. Luck and Risk in Finance. When Bill Gates dropped out of Harvard in 1975 to start Microsoft, most people focused on his genius and ambition. Few noticed that his high school happened to be one of the only institutions in America with access to a computer terminal, or that his best friend's father was a prominent Seattle attorney who could provide legal guidance. Gates himself acknowledges this. If there had been no Lakeside, there would have been no Microsoft. This reality makes many people uncomfortable because we prefer stories where hard work and intelligence determine outcomes. But financial success operates like a 3-legged stool, supported equally by skill, luck, and risk. Remove any leg, and the entire structure collapses. Consider 2 investors in 2008. Sarah, a conservative saver, kept her money in index funds and watched her portfolio drop 40% during the financial crisis. Meanwhile, her colleague Mark had invested heavily in gold the year before on a hunch, seeing his investments soar. Was Sarah foolish and Mark brilliant? Fast forward to 2015, and Sarah's patient strategy had recovered completely while Mark's gold bet had turned sour. The same actions produced opposite results simply due to timing and circumstances beyond their control. The most successful investor of our time, Warren Buffett, provides another compelling example. His extraordinary returns stem partly from skill, but also from an incredibly rare piece of luck, being born male, white, and American in 1930, then having the good fortune to discover his passion for investing as a teenager. Buffett himself admits that had he been born at a different time or place, his natural talents might have led to very different outcomes. This doesn't diminish anyone's achievements, but it demands humility in how we interpret financial results. When someone's portfolio performs exceptionally well, they often credit their research and strategy, When it performs poorly, they might blame bad luck or market manipulation. The truth usually lies somewhere between these extremes. Risk and luck are so intertwined they're nearly impossible to separate. Every financial decision contains both elements, like two sides of the same coin. The entrepreneur who starts a business during a recession faces enormous risk, but if they survive until the recovery, that same timing becomes retrospective luck. Smart financial behavior acknowledges this reality rather than fighting it. This means celebrating successes with gratitude rather than pure pride, and viewing failures as learning experiences rather than personal indictments. It suggests focusing on processes you can control rather than outcomes you cannot, and maintaining enough financial flexibility to survive when luck turns against you. The most dangerous mistake is assuming that because something worked once, skill was the primary factor. Equally dangerous is dismissing good strategies because they happen to fail during unlucky periods. Part 4. Perceptions and Biases. When Warren Buffett was asked about his investing success, he attributed much of it to being born male, white, and in America during the 20th century. This wasn't false modesty. It was recognition of how deeply our circumstances shape what we see as logical financial behavior. Our brains, evolved for survival in small tribes, struggle with the abstract nature of modern money decisions, creating systematic blind spots that can devastate our wealth. Consider the availability bias, which makes recent or memorable events seem more probable than they actually are. After the 2008 financial crisis, many investors avoided stocks for years, missing substantial gains. Their perception of risk was skewed by vivid memories of portfolio losses, not statistical reality. Similarly, during the dot-com boom, investors poured money into technology stocks because success stories dominated headlines, while boring but profitable companies were ignored. The confirmation bias proves equally costly. We naturally seek information that supports our existing beliefs while dismissing contradictory evidence. Daniel Kahneman's research showed that people will literally pay money to avoid information that challenges their investment decisions. A real estate investor might focus on articles about housing shortages while ignoring data about oversupply in their specific market. This selective attention creates dangerous feedback loops where bad decisions seem validated by cherry-picked evidence. Overconfidence bias affects 90% of people who believe they're above-average drivers, a mathematical impossibility that extends to financial decisions. Day traders exemplify this perfectly. Research by Brad Barber and Terrence Odian found that the most active traders underperformed the market by 6.5% annually, yet continued trading because they attributed losses to bad luck and gains to skill. Their confidence grew with each perceived victory, while losses were rationalized away. The anchoring bias locks us onto irrelevant numbers. When Starbucks stock trades at $100, investors might think $80 is cheap, forgetting that the stock was $20 5 years earlier. This mental anchor prevents objective evaluation of current value. Real estate agents exploit this by showing overpriced homes first, making subsequent properties seem reasonably priced by comparison. Perhaps most dangerous is hindsight bias, our tendency to view past events as more predictable than they were. After market crashes, experts appear on television explaining why the collapse was obvious, creating false confidence about predicting future events. This backward-looking certainty breeds complacency and poor risk management. The path forward requires intellectual humility. Successful investors like Ray Dalio systematically challenge their assumptions, seeking contrary opinions and building decision-making processes that account for bias. They understand that being wrong isn't a character flaw. It's an inevitable part of dealing with uncertainty. The goal isn't eliminating bias entirely, but recognizing when it might be influencing crucial financial decisions and building safeguards accordingly. Chapter 2. Behavior over Intelligence. Part 1. What Matters Most. When Richard Branson dropped out of high school at 16, financial experts would have bet against him. Yet today, his net worth exceeds $4 billion. Meanwhile, countless MBA graduates with sophisticated financial models struggle to build meaningful wealth. This pattern repeats across every economic sector and generation. The most successful investors rarely possess the highest IQs or the most advanced degrees. Warren Buffett famously reads annual reports and newspaper articles, not complex algorithms. His approach centers on buying businesses he understands and holding them for decades. Compare this to long-term capital management, a hedge fund staffed by Nobel Prize winners and PhD economists. Despite their intellectual firepower, they collapsed spectacularly in 1998, losing $4.6 billion in 4 months. This stark contrast reveals a fundamental truth about money. Behavior trumps intelligence every time. Jesse Livermore, one of history's greatest traders, made and lost fortunes multiple times because he couldn't control his impulses. His technical skills were unmatched, but his emotional discipline was non-existent. He died broke despite earning today's equivalent of billions. Consider the case of lottery winners. Research from the National Endowment for Financial Education shows that 70% of lottery winners go bankrupt within a few years. These individuals receive windfalls that should secure their futures forever, yet their spending habits remain unchanged. Intelligence doesn't protect them from their behaviors. The same principle applies to everyday financial decisions. A janitor named Ronald Reed accumulated $8 million by the time he died in 2014. He never earned more than minimum wage, but he consistently invested small amounts in dividend-paying stocks for over 60 years. His secret wasn't sophisticated analysis or insider knowledge. He simply bought shares of companies whose products he saw people using every day and never sold them. Meanwhile, day traders armed with real-time data, advanced charts, and trading algorithms consistently lose money. Studies show that over 80% of day traders lose money over any given year, and 99% lose money over longer periods. Their technical knowledge works against them because it encourages overactivity and overconfidence. The most powerful financial habit is also the simplest: consistent saving paired with patient investing. David Bach's research on automatic millionaires found that people who set up automatic transfers to investment accounts accumulated significantly more wealth than those who made manual decisions, regardless of income levels. Your financial future depends less on what you know and more on how you consistently behave. A person who saves 15% of their income and invests it in low-cost index funds will almost certainly outperform someone who saves sporadically while chasing the latest investment trends. The math is straightforward, but the execution requires mastering your impulses and maintaining discipline when markets fluctuate. Financial success isn't about being smart. It's about being consistent. Part 2. Emotional traps. When Richard Fuld, CEO of Lehman Brothers, refused a $2 billion takeover offer in 2007, he believed his firm was worth 10 times more. 6 months later, Lehman collapsed, wiping out $60 billion in market value. This wasn't stupidity. It was emotional decision-making disguised as rational analysis. Our brains weren't designed for financial markets. They evolved to help us survive in small tribes, where immediate threats mattered more than abstract future outcomes. This mismatch creates predictable emotional traps that destroy wealth faster than any market crash. Fear strikes first and hardest. During the 2008 financial crisis, investors pulled $240 billion from stock mutual funds at the market's lowest point. These same people missed the subsequent recovery that doubled their money within 5 years. Fear convinced them that temporary losses were permanent disasters. The brain's alarm system, designed to spot predators, can't distinguish between a charging lion and a declining portfolio balance. Greed operates more subtly, but proves equally destructive. Day traders provide the clearest example. Studies show that 80% lose money within their first year. They're not lazy or uninformed. Many spend hours researching trades. But greed whispers that this time will be different, that they found the pattern others missed. The dopamine hit from a successful trade creates addiction-like behavior, leading to increasingly risky bets. Overconfidence might be the most expensive emotion of all. Nobel laureate Daniel Kahneman found that overconfident investors trade 45% more than their cautious counterparts, reducing their returns by 2.6% annually. Men, who typically display higher overconfidence, trade 45% more than women and earn 1.4% less per year. Confidence feels good, but markets punish those who mistake luck for skill. Herd mentality transforms individual fears into collective panics. The dot-com bubble demonstrated this perfectly. Rational people paid $100 for shares of companies with no profits, no revenue, and sometimes no actual business plan. They weren't stupid. They were following the crowd. When everyone around you is getting rich from technology stocks, standing aside feels like missing the party. But crowds are often wrong at precisely the moments when being right matters most. Professional investors aren't immune to these traps. A study of pension fund managers showed they consistently bought high and sold low, following trends rather than creating value. If professionals with decades of training and sophisticated tools can't escape emotional decision-making, individual investors face an even steeper challenge. The solution isn't eliminating emotions. That's impossible. Instead, recognize when you're feeling them most intensely and pause. Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful sounds simple, but requires fighting every emotional impulse your brain generates. Build systems that work regardless of how you feel. Automatic investments remove the temptation to time markets. Written investment policies prevent you from abandoning your strategy when emotions run high. The goal isn't perfect decisions, it's avoiding the catastrophic ones that emotions create. Part 3. Compounding and Patience. When Charles Schwab's research team analyzed the performance of 25 million client accounts between 2011 and 2020, they discovered something that would surprise most investors. The accounts that performed best weren't those managed by the most sophisticated traders or market analysts. They belonged to people who had forgotten they even had them. The mathematics of compounding creates results that feel almost magical, yet most people abandon this process precisely when it begins working best. Consider the difference between two investors. Sarah starts investing $500 monthly at age 25 and stops at 35, contributing only $60,000 total. Michael starts at 35 and invests the same amount until 65, contributing $180,000. Assuming a 7% annual return, Sarah's account grows to roughly $1.34 million by retirement, while Michael's reaches only $738,000. Time, not timing, created the difference. This phenomenon challenges our intuitive understanding of growth. In the first decade, Sarah's gains feel modest. Her $60,000 grows to perhaps $90,000. The transformation happens later, when her money begins earning money on the money it already earned. By year 30, she's earning more annually from investment returns than she ever contributed in any single year. This delayed gratification runs counter to human psychology, which craves immediate feedback and visible progress. Warren Buffett exemplifies this principle in the extreme. Of his $84 billion net worth, $81 billion accumulated after his 65th birthday. His secret wasn't finding better investments than everyone else. It was staying invested longer. When asked about his investment strategy, Buffett often says his favorite holding period is forever. This isn't hyperbole. It's recognition that compounding requires uninterrupted time to work. The enemy of compounding isn't market volatility or economic uncertainty. It's impatience. During the 2008 financial crisis, many investors pulled their money from the market exactly when they should have stayed put. Those who remained invested through the downturn and subsequent recovery saw their portfolios fully recover and reach new heights within 5 years. Those who fled often miss the recovery entirely, buying back in only after prices had already rebounded. Modern technology amplifies this impatience problem. Apps that show portfolio values in real time create the illusion that daily fluctuations matter. They don't. What matters is that your money remains invested and working. The most successful long-term investors often check their accounts infrequently, understanding that constant monitoring leads to constant tinkering, and constant tinkering destroys compounding's effectiveness. Building wealth requires accepting that the most powerful years come last, not first. This means enduring periods when progress feels invisible, while maintaining absolute faith in the mathematical certainty that patient money grows exponentially over time. Part 4. Money as Control Over Time. When John D. Rockefeller was the richest man in America, a reporter asked him how much money was enough. His answer stunned everyone. Just a little bit more. Even the wealthiest person alive couldn't escape money's most seductive trap, the belief that happiness lies in the next dollar earned rather than in the time already purchased. Money's true power isn't measured in portfolio balances or net worth statements. It's measured in options. Every dollar saved represents future choices, future flexibility, and most importantly, future time that belongs entirely to you. Warren Buffett, despite being worth over $100 billion, still lives in the same modest Omaha home he bought in 1958. He's not cheap. He simply understands that money's greatest gift is the freedom to spend time exactly as he chooses, without external pressures dictating his calendar. Consider the life of Tim Ferriss, who popularized the concept of lifestyle design in the 4-hour workweek. Before building his automated business systems, Ferriss worked 80-hour weeks for minimal pay. The turning point came when he calculated that his boss, despite earning significantly more, had less control over his time than Ferriss did. This realization shifted his entire approach from maximizing income to maximizing autonomy. The difference between being rich and being wealthy lies precisely here. Rich people have money, wealthy people have time. A surgeon earning $500,000 annually but working 70-hour weeks has less wealth than a librarian who saved diligently for 30 years and can now choose her own schedule. The surgeon's high income is offset by complete loss of time sovereignty. This perspective transforms how we evaluate financial decisions. That expensive car payment doesn't just cost money, it costs the months of freedom you could have purchased instead. The oversized mortgage doesn't just create debt, it creates years of mandatory work to service that debt. Every financial commitment is really a time commitment in disguise. Silicon Valley entrepreneur Naval Ravikant frames this concept perfectly. Retirement is when you stop sacrificing today for an imaginary tomorrow. The goal isn't to accumulate enough money to buy expensive things. The goal is to accumulate enough money to buy expensive time. Time to think, time to create, time to be present with people you love. The most financially successful people often discover that money's greatest value emerges not from what it can buy, but from what it can prevent you from having to do. It prevents you from taking jobs you hate, staying in relationships that drain you, or living in places that don't suit you. Money doesn't buy happiness, but it does buy options, and options create the space where happiness can flourish. Chapter 3: Wealth, Happiness, and Enough. Part 1: The Never Enough Syndrome. When billionaire investor Charlie Munger was asked what he'd wish for his worst enemy, his answer stunned everyone: the ability to get whatever they want. Research from Stanford University reveals that lottery winners, despite gaining millions, show no significant increase in happiness after just 2 years. This phenomenon affects everyone, from minimum wage workers dreaming of raises to billionaires building their third yacht. The human brain operates like a hedonic treadmill, constantly adjusting expectations upward. What felt like luxury yesterday becomes today's baseline necessity. Tech entrepreneur Sean Parker, co-founder of Facebook, captured this perfectly when he admitted that despite his billions, he still felt the urge to accumulate more power and wealth. describing it as an addiction. Consider the trajectory of professional athletes. NBA players earning league minimum salaries of $925,000 often report feeling poor compared to teammates making $40 million annually. This isn't about being ungrateful. It's about human psychology. When your reference group consists of multimillionaires, even substantial wealth feels insufficient. The same dynamic plays out in corporate boardrooms where executives earning $500,000 feel underpaid compared to their $2 million counterparts. Psychologists call this the comparison trap, but it runs deeper than simple envy. Our brains evolved during times of scarcity, when gathering more resources directly improved survival odds. Today, this same mechanism fires endlessly in environments of abundance, creating what researchers term psychological poverty among the financially successful. The cost extends beyond personal dissatisfaction. Families making $200,000 annually often carry more stress than those earning $75,000, primarily because higher earners tend to increase spending proportionally, maintaining the same financial pressure despite greater income. They upgrade houses, cars, and lifestyles, but rarely upgrade their sense of security or contentment. Real wealth builders understand this trap intuitively. Warren Buffett still lives in the Omaha house he bought in 1958 for $31,500. When asked why, he explains that the house serves its purpose perfectly. Adding square footage or luxury features wouldn't increase his actual happiness or productivity. This mindset shift from more is better to enough is plenty represents perhaps the most critical psychological adjustment in building lasting wealth. The antidote requires conscious intervention against our natural impulses. Successful investors often practice what psychologists call gratitude anchoring, regularly reflecting on past financial struggles or current advantages. This isn't about settling for less. It's about recognizing when additional accumulation serves ego rather than genuine improvement in quality of life. Breaking free from the never-enough cycle doesn't mean abandoning ambition. Instead, it means defining success internally rather than through external benchmarks. When you measure progress against your own past rather than others' presence, contentment becomes achievable, and wealth serves its intended purpose of providing security and freedom rather than feeding an insatiable psychological hunger. Part 2. Status versus freedom. When Warren Buffett drives his 2014 Cadillac XTS to work each morning, he passes luxury car dealerships filled with vehicles costing more than most people's homes. Yet America's third richest person chooses function over flash, freedom over facade. This choice represents one of investing's most overlooked principles, the fundamental tension between status and financial independence. The status game operates like quicksand. The more you struggle to climb higher, the deeper you sink financially. Consider professional athletes who earn millions yet frequently declare bankruptcy within years of retirement. A 2009 Sports Illustrated study found that 78% of NFL players face serious financial distress within 2 years of leaving the game. These aren't people lacking income. They're individuals trapped by the relentless pressure to display wealth through expensive cars, jewelry, and homes that drain their earning power. Status spending creates what economists call lifestyle inflation, but the psychological component runs deeper. Each purchase designed to impress others requires the next, more expensive purchase to maintain the same social impact. The luxury watch loses its power when everyone in your circle owns one. The sports car becomes commonplace. The mansion feels modest compared to your neighbor's estate. Consider two software engineers earning identical salaries. Sarah drives a reliable Honda, lives in a modest apartment, and invests 40% of her income. Meanwhile, Mike leases a BMW, rents a luxury apartment, and struggles to save 5% of his paycheck. After 10 years, Sarah possesses genuine freedom to change careers, take risks, or retire early. Mike remains chained to his job, requiring every paycheck to maintain his lifestyle. The freedom path looks different. Instead of optimizing for others' opinions, it optimizes for personal autonomy. This doesn't mean living like a monk or avoiding all pleasures. It means understanding that every dollar spent on status is a dollar that can't work toward your independence. Real freedom manifests in options. The ability to say no to unreasonable demands at work. The choice to pursue passion projects without worrying about immediate income. The luxury of time itself, rather than the luxury of things. Dave Ramsey, who built his financial empire after declaring bankruptcy, often tells audiences that his proudest possession isn't his expensive home, but his peace of mind. He sleeps well because his choices prioritize long-term security over short-term validation. The irony is profound. Those who chase status often achieve neither status nor freedom, while those who pursue freedom frequently gain both. True status comes from genuine accomplishment and financial security, not from the appearance of wealth. Which path will you choose? The one that impresses strangers at traffic lights, or the one that grants you control over your time and destiny? Part 3. Social Comparison. When Susan Chen graduated with her MBA in 2018, she earned $85,000 annually and felt financially secure. 3 years later, despite earning $125,000, she felt poorer than ever. The difference wasn't her bank account. It was her social media feed, filled with former classmates posting vacation photos from Dubai and kitchen renovations that cost more than her car. Social comparison represents one of the most destructive forces in personal finance, turning objective financial progress into subjective misery. The human brain isn't wired to evaluate wealth in absolute terms. Instead, we measure our success relative to those around us, a psychological trap that economist Robert Frank calls positional competition. Consider the famous study by Harvard researchers who asked participants whether they'd prefer earning $50,000 when everyone else earned $25,000 or earning $100,000 when everyone else earned $200,000. Most chose the first option, preferring to earn less money but maintain higher relative status. This reveals the uncomfortable truth. We often care more about beating others than improving our own circumstances. Instagram and LinkedIn have weaponized this tendency, creating what researcher Tim Kasser calls materialistic value orientation. We see carefully curated highlights from hundreds of acquaintances, not just our immediate neighbors. A 2019 study by NYU found that people who spent more time on social media reported higher financial anxiety regardless of their actual income level. The comparison trap becomes particularly vicious because we never see the complete picture. That colleague posting from Napa Valley might have financed the trip with credit cards. The friend buying a Tesla might have depleted their emergency fund. We compare our behind-the-scenes reality with others' highlight reels, creating impossible standards. Warren Buffett, despite being worth over $100 billion, still lives in the same Omaha house he bought in 1958 for $31,500. He once joked that his neighbor probably thinks he's the poorest billionaire in America. Buffett understood something crucial. Wealth isn't about impressing others. It's about having options. The antidote to comparison isn't ignoring others entirely, but changing your reference points. Instead of measuring against peers, measure against your past self. Are you more financially secure than last year? Can you handle emergencies better than before? Do you have more choices about how you spend your time? Charlie Munger, Buffett's longtime partner, suggests the jealousy test. If you feel envious of someone's financial situation, ask yourself if you'd trade places completely, their debts, family situation, health problems, and all. Usually, the answer is no. Your financial journey is uniquely yours, shaped by different goals, values, and circumstances. The moment you start measuring your progress against someone else's scoreboard, you lose sight of your own finish line and risk making decisions that serve their priorities instead of yours. Part 4. Room for Error and Survival. When NASA designs spacecraft, engineers build in what they call margin of safety, extra fuel, backup systems, redundant components. They know that in the vacuum of space, there's no room for close enough. Your finances operate in a similarly unforgiving environment, where unexpected events can derail decades of careful planning in mere months. The most successful investors and wealthy individuals share a counterintuitive trait. They plan for failure. Warren Buffett keeps Berkshire Hathaway's cash reserves at levels that seem almost excessive to outsiders, sometimes $100 billion or more, sitting in treasury bills, earning modest returns. Critics call it inefficient. Buffett calls it essential. He learned from the 1970s recession that companies with strong cash positions could buy distressed assets while over-leveraged competitors went bankrupt. Building financial buffers isn't about pessimism, it's about acknowledging reality. The average American faces a major financial setback every 7 to 10 years. Job loss, medical emergency, divorce, or market crash. Yet most people plan their finances assuming everything will go perfectly. This disconnect between expectation and reality destroys more financial plans than any single catastrophic event. Consider the difference between surviving and thriving during the 2008 financial crisis. Families with 6 months of expenses saved could weather job losses and wait for better opportunities. Those living paycheck to paycheck were forced into desperate decisions, selling investments at the bottom, taking high-interest loans, or accepting any available work, regardless of career impact. The mathematics of financial survival are unforgiving. A 50% loss requires a 100% gain just to break even. A 75% loss demands a 300% recovery. These aren't theoretical numbers. They represent years or decades of additional work. The dot-com crash erased 15 years of stock market gains. Some investors never recovered because they couldn't afford to wait. Smart money management means assuming you'll be wrong about something important. Your industry might decline faster than expected. Your health might deteriorate earlier than planned. Interest rates might stay higher longer than projected. Building room for error means your financial plan can absorb these shocks without derailing your long-term goals. This approach requires genuine humility about your ability to predict the future. John Maynard Keynes, one of history's most brilliant economists, lost nearly everything in the 1929 crash because he was overconfident in his market timing. He rebuilt his wealth using a completely different strategy: broad diversification, long holding periods, and substantial cash reserves. The goal isn't to hoard money out of fear, but to create options when others have none. Emergency funds aren't just for emergencies, they're for opportunities. When everyone else is selling in panic, those with financial buffers can buy at discount prices. When others are desperate for work, those with savings can be selective about career moves. Room for error transforms financial setbacks from disasters into detours. Chapter 4, Making It Last, Part 1, Getting Wealthy versus Staying Wealthy. Warren Buffett made most of his wealth after his 50th birthday. Jim Simons generated 99.9% of his net worth after age 50. This pattern reveals a profound truth. Getting wealthy requires taking risks, but staying wealthy demands a completely different approach. Most people who achieve financial success eventually lose it because they mistake the skills that built their fortune for the ones needed to preserve it. Building wealth operates like entrepreneurship. You need concentrated bets, aggressive growth strategies, and the willingness to risk significant losses for potentially massive gains. Jesse Livermore made and lost fortunes multiple times throughout the early 1900s because he treated wealth preservation like wealth creation. Each time he rebuilt his fortune, he immediately returned to the high-risk speculation that had made him rich, only to watch it evaporate again during market downturns. Preserving wealth requires an entirely different psychology. While accumulation rewards boldness, preservation demands paranoia. When you have something valuable to lose, your primary job shifts from maximizing returns to minimizing the chance of permanent loss. This means accepting lower returns in exchange for higher certainty. Consider the difference between Bill Gates during Microsoft's startup years versus his approach today. Young Gates took enormous risks, worked relentless hours, and made concentrated bets on emerging technologies. Today, the Gates Foundation maintains diversified portfolios across multiple asset classes, focusing on steady, sustainable growth rather than home-run investments. The wealthy who stay wealthy understand that survival trumps performance. They know that earning 8% annually for 30 years creates more wealth than earning 30% for 10 years, followed by a devastating loss. This mathematical reality explains why many lottery winners and professional athletes lose their fortunes within a few years of acquiring them. Adaptation becomes critical as circumstances change. What worked during your wealth-building phase may become dangerous during preservation mode. The economy evolves, industries shift, and personal situations change. Rigid adherence to past strategies often leads to financial ruin. John D. Rockefeller adapted from oil refining to diversified investments as his wealth grew, recognizing that concentration risk increases with portfolio size. Humility protects wealth better than confidence. Overconfidence leads to unnecessary risks and poor timing decisions. The wealthy who maintain their fortunes often appear surprisingly cautious to outside observers. They understand that markets are unpredictable and that past success doesn't guarantee future results. Perhaps most importantly, staying wealthy requires accepting that you have enough. The psychological drive that pushed you to accumulate wealth can become your greatest enemy once you've achieved financial security. Learning when to stop taking unnecessary risks separates those who build lasting wealth from those who repeatedly cycle between fortune and failure. The skills that make you rich and the skills that keep you rich operate in fundamentally different ways. Part 2. Optimism versus Pessimism. When the 2008 financial crisis hit, Warren Buffett made one of his most famous declarations: "Be fearful when others are greedy, and greedy when others are fearful." While millions panicked and sold their investments at massive losses, Buffett invested billions. His optimistic stance during humanity's darkest financial hour generated extraordinary returns. Yet paradoxically, pessimism often feels more intelligent than optimism in financial circles. Pessimism sounds profound. When someone predicts market crashes or economic collapse, they appear sophisticated and analytically rigorous. CNBC doesn't invite guests to discuss how stocks might climb steadily for decades. They want drama, predictions of doom, and complex explanations for why everything will fail. This creates a dangerous psychological trap where smart-sounding negativity becomes more appealing than boring positivity. Consider the track record of prominent pessimists. Peter Schiff correctly predicted the 2008 housing crash and became a media darling. However, his subsequent decade of bearish predictions cost investors who followed his advice enormous returns. Meanwhile, Jeremy Siegel's optimistic stance on long-term stock ownership, though less exciting, has proven remarkably accurate over multiple decades. The mathematics of pessimism versus optimism in markets tells a compelling story. Since 1871, the U.S. stock market has experienced 33 recessions, 2 world wars, a Great Depression, and countless crises. Yet someone who remained optimistically invested throughout this turbulent period would have seen their money grow by millions of %. The pessimists who sold during each crisis missed the recoveries that followed. This doesn't mean blind optimism serves investors well. The dot-com bubble and housing boom prove that excessive optimism creates devastating bubbles. The key lies in calibrated optimism based on historical evidence rather than current emotions. Ray Dalio calls this principled thinking, maintaining faith in long-term progress while preparing for inevitable short-term setbacks. Behavioral finance research reveals why pessimism feels so seductive. Humans evolved to notice threats more acutely than opportunities. Our ancestors who obsessed over potential dangers survived better than those who remained perpetually optimistic. This hardwired negativity bias makes market crashes feel more likely and memorable than steady growth periods. The most successful long-term investors combine realistic pessimism about timing with unwavering optimism about progress. They assume they cannot predict when markets will fall, but maintain confidence that innovation, productivity, and human ingenuity will drive long-term growth. This balanced approach allows them to prepare for volatility without abandoning their investment strategy during difficult periods. Your financial mindset shapes your behavior more than market conditions ever will. Pessimists often sell at the worst possible moments, while optimists sometimes hold losing positions too long. The sweet spot requires historical perspective, acknowledging that painful periods are inevitable while recognizing that progress ultimately prevails over setbacks. Part 3. Stories Shaping Finance. When Warren Buffett's Berkshire Hathaway stock fell 50% during the dot-com bubble, while tech stocks soared, investors questioned his outdated approach. The prevailing story painted traditional value investing as obsolete, replaced by a new paradigm where profits no longer mattered. This powerful narrative drove billions into companies with no earnings, creating one of history's most destructive bubbles. Stories move markets more than spreadsheets ever will. When everyone believes the same financial narrative, it becomes a self-fulfilling prophecy until reality intervenes. The dot-com era demonstrated how compelling stories about technological revolution and endless growth potential could override fundamental analysis for years. Investors abandoned proven strategies not because the math changed, but because the story changed. Consider the 2008 housing crisis. Built on the narrative that real estate prices never fall nationwide, this story seemed logical. People need homes, land is finite, and previous generations built wealth through property. Mortgage brokers, bankers, and homeowners all believed this story so completely that they ignored mounting evidence of unsustainable practices. When countrywide financial collapsed, it wasn't because housing mathematics suddenly shifted, but because the underlying story proved false. Financial media amplifies these narratives because stories sell better than statistics. During the GameStop frenzy of 2021, the story of retail investors defeating Wall Street hedge funds captured public imagination. The narrative wasn't about GameStop's business prospects or intrinsic value. It was about David versus Goliath, ordinary people striking back against institutional power. This story drove the stock from $20 to over $400 in weeks, demonstrating how emotional narratives can temporarily overwhelm financial fundamentals. Personal finance stories prove equally powerful. The widespread belief that homeownership always builds wealth has driven millions into mortgages they couldn't afford. This narrative ignores opportunity costs, maintenance expenses, and market timing risks. Meanwhile, the story that debt is inherently evil prevents many from leveraging low-interest loans for investments with higher expected returns. Successful investors develop immunity to seductive stories by focusing on enduring principles rather than current narratives. Ray Dalio's Bridgewater Associates succeeded by questioning popular financial stories and testing them against historical data. When everyone believed that certain asset classes always moved together, Dalio's research revealed these correlations changed during crisis periods. The most dangerous financial stories feel obviously true. During bull markets, the story becomes, "This time is different. Technology has changed everything. Old rules no longer apply," or "We've conquered economic cycles." During bear markets, the story shifts to permanent decline, questioning whether markets will ever recover. Building wealth requires separating timeless financial principles from temporary narratives. Stories about getting rich quick, beating the market consistently, or finding secret formulas appeal to our desire for shortcuts. Reality demands patience, diversification, and accepting that boring strategies often produce the best long-term results. Your financial success depends more on resisting compelling stories than on finding the next great investment narrative. Part 4. Building a Personal Philosophy. When Warren Buffett was asked about his investment philosophy, he didn't quote textbooks or recite universal principles. Instead, he described his temperament: patient, curious, and comfortable with uncertainty. This insight reveals something profound about financial success. The most powerful money strategies aren't found in generic advice columns, but emerge from honest self-reflection about who you are and what you truly value. The finance industry thrives on one-size-fits-all solutions. Investment newsletters promise universal formulas, financial advisors push standardized portfolios, and best-selling books claim to have discovered the secret to wealth. Yet the most successful investors throughout history have created deeply personal approaches that match their unique circumstances, personalities, and goals. Consider Ray Dalio, who built Bridgewater Associates into the world's largest hedge fund. His investment philosophy centers on radical transparency and systematic decision-making, principles that reflect his analytical nature and desire to remove emotion from financial choices. Meanwhile, Peter Lynch achieved legendary returns at Fidelity by investing in companies he could understand through everyday observations, a strategy perfectly suited to his curious, observational personality. Your financial philosophy shouldn't mirror theirs. It should reflect your own relationship with risk, time, and money itself. Some people sleep better with 6 months of emergency savings. Others feel comfortable with 3. Neither approach is wrong. They simply reflect different comfort levels with uncertainty. Creating your personal money philosophy starts with brutal honesty about your temperament. Do you panic when markets drop 10%, or do you see buying opportunities? Are you naturally optimistic about the future, or do you prepare for worst-case scenarios? Can you stick with a boring index fund for decades, or do you need more active involvement to maintain interest? Your life circumstances matter just as much as your personality. A single parent needs different financial strategies than a dual-income couple without children. Someone planning early retirement requires a different approach than someone who loves their work and plans to continue indefinitely. Age, income stability, family obligations, and health considerations all influence what constitutes sound financial advice for you specifically. The most dangerous financial mistake isn't choosing the wrong investment. It's adopting someone else's philosophy without considering whether it fits your situation. A day trader's aggressive approach might generate impressive returns, but if the stress keeps you awake at night and affects your relationships, those gains come at too high a cost. Building your philosophy requires experimentation and adjustment. Start with small amounts when trying new strategies. Pay attention to how different approaches make you feel, not just their financial returns. Your ideal money management system should feel sustainable and aligned with your broader life goals. The goal isn't finding the perfect financial strategy. It's developing an approach you can maintain through market volatility, life changes, and the inevitable challenges that test every investor's resolve. Your money philosophy becomes your anchor when stories and emotions threaten to pull you off course.